us in a First on CNBC interview is Hugh Johnston, Vice Chairman and Chief Financial Officer of PepsiCo. We should mention that Hugh also serves on our CNBC Global CFO Council. As always, it's good to see you this morning, Hugh. We're in a, I don't know, are we in a post-Omicron phase yet? I guess maybe the past 3 months, you wouldn't say post, but it appears that we're getting close. What was business like with that in mind, with the waning stages, hopefully, of the pandemic in mind?
Yeah, good morning, Joe. Good to be with you all. I won't weigh in on the post-Omicron thing. I'm not an epidemiologist, but I think in general, you're seeing our business perform awfully well. You saw 12% revenue growth for the quarter, which we're quite pleased with. And for the year, 9% revenue growth and 12% EPS growth. So we feel really good about the momentum we have in the business right now. As you all noted in the open, certainly there's lots of cost challenges out there. Supply chains are certainly still challenged to some degree. But as we look forward into 2022, our expectation is 6% revenue, 8% EPS. We ought to get through the year with our margins pretty well intact because with the strength of our brands and the strength of our innovation, we think we have sufficient pricing power to manage the cost input inflation that we're facing.
Yeah, that's what I was alluding to, all the different cross currents. You know, people stayed home and snacked, obviously, but then they didn't go out and get soda drinks from maybe restaurants. So that's a plus and a minus there. There's supply chain, there's inflation. I mean, there's just all types of variables. The last 3 months, was there something that was more important than other in terms of either helping or hurting your business?
Well, I think, as you saw, during the course of the quarter, people earlier in the quarter were getting out a bit more. Obviously, with the Omicron variant, there was a little bit more return to home, and now you see people getting back out again. One of the great strengths of our company, though, is wherever you're going to be, we're going to have products for you. You know, if you're out on the road, our convenience business is growing terrifically well. If you're doing more at home, obviously our grocery and large format business is doing well. And when people go back to restaurants, we've got terrific market share there. So one of the advantages of being everywhere is people are going to consume our products regardless of where they are.
And you're going to have to pay more for all types of things, ingredients, transport, logistics, all those things. Are you able, with your products, are they that near and dear that they're inelastic, or people are going to need Doritos no matter what?
You know, yeah, we do have a lot of pricing power. We have seen the elasticities actually stay pretty low thus far. Now, how that plays out over the course of the year is obviously the great question. I think the thing that we look at is as long as we keep investing in our brands, we keep investing in our ability to bring products to market. Generally speaking, especially in stressful times as we're in right now, people are looking for smiles. They're looking for simple pleasures. And that's really what we bring to them, whether it's sort of tearing open a bag and having that Cool Ranch flaming hot Dorito that you were talking about earlier, or having a simple Pepsi, getting together with people at the Super Bowl. They're willing to pay for our products because they are relatively inexpensive, and they really are part of the fabric of what makes people smile every day.
Hey, Hugh, we were speaking with Roger Ferguson earlier, just talking about CEO expectations, specifically when they're looking at inflation. And we were just talking about how, in some ways, it can be a self-fulfilling prophecy. CEOs think they have to rise prices because they know or expect that their input costs are going to go up. How much are you anticipating input costs are going to go up? And as a result, how much are you planning on raising prices for the rest of this year?
Yeah, so for the year, we're expecting commodity inflation really about low double digits. It's going to be pretty high for us. You may recall, Becky, and we've talked about this a bit in the past, we tend to buy forward on commodities anywhere between 6 and 12 months, probably averages about 9. So I understand what Roger is saying is people are trying to get in front of it. For us, it's more we give ourselves pretty good price certainty by buying ahead. So therefore, we plan for potentially higher inflation, but we react with our pricing to the facts. We don't have to react to what we expect to have happen. We have pretty good certainty on what's going to happen.